All right, guys, we'll get started. We're going to talk about the 2018 trends in the economy, population, real estate. I've got a lot of slides here, almost 100, so we're going to try and race through them as fast as possible. But I wanted to introduce myself. My name is Lane Kawaoka. I am the creator of SimplePassiveCashflow.com and the podcast. I have a bachelor's in industrial engineering and civil engineering, professional engineer. I still work the day job. I got my start as a construction manager. There I am on the left side of the screen, and I transitioned in 2013 to more of a project manager role, and then the city engineer role in 2015. Currently, I'm still an airfield engineer working for the Department of Transportation. And LinkedIn always tells me to look for another job, but I'm not really interested. My real estate investing is much more my passion, and that started. I grew up in Hawaii, and I moved to Seattle in 2003, where I went to UW for school. I began investing in 2009 as an accidental landlord in an A-class rental, and shortly after I saw the light in investing for cash flow instead of appreciation. I went out of state for cash flow, and I invested in 11 single-family homes in Birmingham, Atlanta, Indianapolis, and Newcastle, Pennsylvania. I invested in some farmland, and I mostly invested in myself, putting a lot of money into my education, joining different masterminds and groups. 2016, that's when I saw that the end in sight for working at a day job and in the rat race. And at that point, my mindset really shifted. Again, I saw me sitting at the beach drinking pina coladas and pretty much doing whatever I wanted because I had the freedom to really do that. But I started to do this podcast because I always loved the podcast format. So it's available on iTunes, Google Play, YouTube. Made the Facebook groups and try and build a community around it. And then things really started to blow up from there. And I just started to get all this like emails from all you listeners out there. And then the growth just started to happen. But I saw this big problem, right? The people that were calling me were, young families, people who were struggling financially. And then life just kind of sucked because they just had to go to the job and commute long hours, and a lot of people just don't really like what they do for work. So I had all this feedback coming back, and a lot of it can be found at simplepassivecashflow.com/testimonials. But it was pretty apparent that I started to really focus in on growing this brand. And in 2017, I moved back to Hawaii, invested some more money in my education, and started partnering with investors in the Hui Deal Pipeline Club, which you guys can join for free. We've acquired $50 million in real estate and raised over $4 million within the group just over the last couple of years. I'm co-owner of MFP Investments, and we own 825 units, mostly apartment buildings. And that's a little bit who I am. We're going to talk about these trends, and we'll kind of just race through them. And I just wanted to let you guys know that a lot of this information were put forward from a variety of sources. And none of this is to be taken as legal advice or CPA advice. There's mostly infotainment here. So I've got this split up in 7 different categories that kind of cluster a lot of the trends in the same place, so it makes sense. So the first category is population. So, America, where we live, we're pretty fortunate that our population is growing. And as you can see, the baby boomers are kind of making their way through the system on the right side of the screen. And then the millennials and Gen Xers are kind of making their way through the system. A lot of the population growth is from immigrants coming in, shown here. This is the graph of the home ownership rates. As you can take note of 2009, 2010, that's when the recession hit. And, George Bush, when he took office, one of his initiatives was to get everybody into home ownership. And the lending kind of reflected that, all the aggressive standards that they had or lack of standards. So that's kind of made this graph go all the way up to 69%. I personally think that it should be a lot lower than that. A lot of people just shouldn't be able to buy a house, or they're fine renting. I mean, I personally rent. I think it's fine. Household formation. This graph just tells it all. Like, people are getting married a lot later in life. Apparently, men get married 2 years later than women, but they also die 2 years earlier too. More graphs kind of saying the same thing. The millennials are, they're getting married later. Is this kind of tracks married households going down and unmarried households going up. So, these demographics are, keep this in mind when you're looking for rental properties or what kind of investments you're going into. So some of the news articles that are coming out are, the baby boomers are, a big part of this population that are making its way through. And a lot of these folks are becoming new renters. The kids are moving out. They're targeting more high-rise buildings in downtown neighborhoods to be in the vicinity of better places. This visual is pretty interesting. They talk about the different generations, and baby boomers here, they will retire early to mild climates. So they're saying that they'll go more towards the southern states. But they're saying what maybe we don't know is they'll continue to work due to financial necessity, because a lot of them got slaughtered in 2008. And also boomers are continuing to work later in life. 32% aim to retire between 65 and 69, and 27% aiming to retire at 70 years or older. By 2024, nearly 30% of the population is expected to still be in the labor force. Yeah, just crazy, especially when some of you guys are thinking about you're going to retire by 40. So I think the best bet obviously is senior housing, right? But that senior housing is definitely a business, and but I definitely believe in that investment. Gen Xers are looking for bigger houses because they're looking to step up at this time. But they're looking for more work-life balance. The millennials, users of sharing economy is a big thing for them. And, they're going to be creating households and having kids at some point here. And they're going to be looking to select suburbs or secondary markets for quality of life. The Gen Zs, the guys, who are sort of going through high school right now, these are the tech savvy from birth. We don't know what they're going to be like, right? They're oriented towards pragmatism, and they use caution and personal security. And they're born in technology, and they're not adopters of it. They're super social and mobile and interactive in their digital lives. The initial housing preferences are in urban centers, but they have a much higher desire for home ownership than their millennial counterparts. They watch the flipper shows, and it's being projected that they'll be looking for low-cost fixer-uppers. And they're not going to be tied to the major markets. So they're saying that they'll probably shift to the secondary markets because it just makes more sense from a value perspective. They're a lot more pragmatic. And in the workplace, Gen Zs are supposed to be open to mentoring and hands-on management, and less tolerant than the sharing millennials with all their Ubers and all that stuff. This slide is saying how the student debt bubble is happening. Yep, a lot of millennials are going to need a roommate. They're saying that 30% of American singles are needing a roommate, up from 21% just a little over a decade ago, to afford the monthly rent payments. So they're saying that this is just not limited to the primary markets, but also the secondary markets, places that we like to buy those rental properties at. So from a big perspective, where are people moving around? I like to use this United Van Line report. So the Van Line report is usually for white-collar migration. So, if you're a corporate worker, a white collar worker, when you get shipped off to, move across state, they'll send you via van line. It'll be basically on company expenses. So this kind of tells a tale. They're moving from, you can see Seattle up here. I mean, that's kind of the darling story up in the Northwest. I mean, I just lived there in the last 2 or 3 years. I mean, South Lake Union is just totally different because of Amazon and Google in Kirkland. You got the South here, something happening here, and some interesting things. What's happening here to Florida? There's not as much growth in Florida as much now, and Texas is kind of cooling off a little bit based on this report. And Illinois is definitely a place that we hear a lot of bad news on, with the government being in debt and all the entitlement programs there. The U-Haul report is another report, and this is kind of the blue collar worker or the cheapo who's going to be moving. A lot of younger professionals just out of college will use the U-Haul. I mean, I use the U-Haul a lot, and these are the do-it-yourselfers. So a lot of the people are going to Texas, Florida, Arkansas, South Carolina, Tennessee, and Washington. So a lot of southern states, other than the anomaly in there, Washington, which I would say is still a lot of tech people. So, and I do distinguish between the two. All those southern states, those are blue collar jobs. The Washington tech jobs, those are definitely white collar. I mean, a lot of those guys make $120,000 starting pay or more. Just another image here for migration. The red is where they're leaving, which is California, Illinois, or Chicago, Illinois there, and they are going to the south. Some interesting points is the first year Arizona has made the leader in inbound moves. Illinois topped the outbound moves, and for the last 5 years, the states with the highest move totals haven't changed. These are Florida, California, and Texas. Tennessee made a first-time debut on the first-time inbound states, and California made its first debut on the top 5 outbound states. So here's just another, just by dollars, how much investment is in each region. So as you can see, the way I look at this is, from 2009, the recession, definitely a lot more dollars coming in. We're not quite to the peak of where we were, but definitely right there. Again, just a more table format from another study. Texas is up there with the highest percent change of population since 2010. California is still growing, but not as much. Florida is also another big one. And, we talk about Texas a lot, and for good reason. And this is where all the people move into Texas, these are the states where they're coming from. So as you can see, California, New York, Louisiana, Illinois, Missouri. So this is a ranking from Wallet Hub. And the headline was Best City for Jobs. Not necessarily, blue collar, the kind of jobs we kind of look for, but these are, it's from a magazine, so they're going to kind of cater towards the yuppies. So they're saying a lot of Arizona cities on here, California, there's Texas on here. They're saying, this is from the same yuppie magazine, most job opportunities, hey, South Carolina made it in there. Highest employment growth, again, Arizona. That's the way I read this. U.S. job opportunities, there, everybody talks about Detroit. When a lot of people are kind of jumping in there. I'm still not sold on that place. And lowest employment growth. Oklahoma City's on there, but I always say, like, if you underwrite your numbers properly and use like 10% vacancy in Oklahoma City, you should be fine as long as your numbers work and you write on conservatively. Highest month starting salary, of course, in the Northwest. I mean, these are all the tech jobs coming through. Highest unemployment rate, there, Detroit. Poor Detroit. Highest median, Texas, Kansas, and Arizona. And most affordable housing, Cedar Rapids, Iowa, and Des Moines, Iowa. Couple places I'm doing some stuff at there. Just boring old Midwest. And Huntsville, Alabama. Definitely have some tech jobs in that area. Longest average commute time, there it is, Pearl City, Hawaii. I mean, we've here in Hawaii, we've got some of the worst traffic out here, despite paradise. Least affordable housing, Oklahoma or Oakland, California. I'm guessing because they're getting a lot of overflow from people in the Bay Area, San Francisco. They're just looking for places to live. This is a graph of the best and worst cities for jobs. And some micro migration patterns. So they're saying that the next frontier is the suburbs. So the picture on the left sort of depicts in a symbolic way, like, you're going to have these pockets of growth, these very dense developments. But what right now is the dormant area, which is between them. And they're saying that's what's going to be growing. So here's Long Beach, California, here in LA. And you can see this is a picture from the 1950s. And as you can see it transitioning a couple decades later, you can see how the red pieces, they get put in different places and how the growth happens. And here it is more current day. And you see how the density is kind of filled in there. And that's kind of this is kind of the motto, how they're predicting a lot of cities to form. Switching gears to the economy. So before I go to the economy slides, I just want to preface this with a certain kind of lens as investors. You need to think, who is your tenant? And think of the employment or the key indicator that's driving the economy. There's three kinds of employments. There's a tertiary employment. These are the guys who are pouring coffee, cleaning clothes, mowing lawns, barbers. They're kind of the third tier where the money's coming from. The second tier is the guy doing the construction work, like Robert the railroad worker, or Mike the mechanic, or Bob the backhoe operator. And that primary employment is the manufacturing company. So when you're thinking of economies, I would think of it in terms of primary, secondary, and tertiary. So you always look first for that primary or secondary driver in a market. So this is kind of like a trick table here. This is a slide about, where all the worker or the warehouses at. And, there's a lot of warehouses. I know there was one in Kent, Washington that came up for Amazon, but there's nobody that works in it. It's all robots. So, just this slide is here just to kind of be a reminder to kind of take everything with a grain of salt and do a little digging when you hear the big news like that. I think it's a no-brainer that the stocks are up. All-time highs. It's hit all-time highs almost 70 times in 2017. So the corporations are currently taking stock off the market to reduce supply, but demand still comes in as bullish investors are piling in and prices continue to rise. Retail sales are accelerating, with sales, excluding automobiles, they're having trouble. And I think the last Christmas sales season was up 4.9%, which is pretty big. I mean, they had the biggest Black Friday weekend ever. E-commerce drove a lot of this, rising 18.1% over the same period. And online sales surpassed 3 billion on that Black Friday and Cyber Monday, shattering single-day e-commerce records. I think it's no surprise that Amazon's coming and going to take over the world here. They bought Whole Foods. And here's some other things that you don't really know about. I mean, I have a lot of friends working at Amazon, and they're saying that the things coming down the pipeline is, they have Amazon stores, but they're not really stores. They're more as testing grounds to prove this payment system that they're coming out with. So think of like Amex, MasterCard, and Visa, what huge powerhouse companies they are. because they just get a piece of every single transaction. Now Amazon wants a piece of that, so they're coming after that. And they're also coming after the drug companies. So Aetna and CVS kind of saw this and they teamed up. And shortly after, Amazon and Berkshire Hathaway are working on something similar to kind of go head to head with them. So, I don't want to make this into some kind of political thing. I don't even vote. I don't even know what's what, but I do know the difference between Obama and Trump, and I'll kind of illustrate the differences just from an economy perspective. Again, putting all politics on the side. So Obama did this thing called the trickle-down Greenspan approach, or the Bernanke-Yellen style, which is a financial way of deregulation, which opened the door for cheap money. And then, think of all the QE that came in. Now, Trump's idea is to do a trickle-down Reagan style, which is running up the debt and the military spending. And this pumps a lot of cash into the economy, and it's supposedly to create a boom. So on the Obama side, they pumped up the paper assets to make the uber rich richer on paper. And their theory was that the uber rich would lend money to Main Street, who would then spend it, who would then spend their money and eventually make their way to the barista that serves your coffee, or that going from primary, secondary to that tertiary worker. Kind of going straight to that tertiary worker, actually. But it kind of sounds like a little leftovers to me. The Trump style, which is really Reaganomics, worked because starting out, the U.S. had a good balance sheet and lots of manufacturing capacity, and had high interest rates. The idea is to create an environment attractive to your Acme manufacturing, or having a lot of these people come back to the United States, because a lot of people have left the United States because of the taxes, and then have them on Main Street. So his style is sort of a mix between Reagan-style tax cuts and military spending. More Greenspan, Bernanke, Yellen-style cheap money and pumping in the market. It's kind of a blend between the two. But it's all strategically aimed to boost the domestic manufacturing. So getting it to that primary and secondary economic driver that we spoke about earlier. So it's no secret where we are in the market cycle. We're definitely in the seller's market. And that also means it's a contractor's market. So a lot of you guys are having trouble finding decent contractors. And I would say, if you find a contractor out there who's doesn't have any work, I would really question if that's someone you really want to be working with. When I was working with the city, some of the workers like to read the Wall Street Journal, or like to read the bids that come out. I don't know why. It sounds like a really boring thing to do, but all the news and all the bids that come out, I mean, it's obvious the contractors' prices are going up because of demand. I mean, you guys can go to your local Department of Transportation site, and it's all public records. You can see how the trends are, on some, key things like concrete per square foot or something like that. Just look at the prices over the years. Another big trend, trucking. On 2017, December 18th, they created this the electronic logging device rule for all commercial trucks, which what this is, so when I used to be a supervisor, I had truck drivers that worked for me, and they have these logs that they have to fill out. And the purpose of those logs is so that these guys don't drive 24 hours straight and kill somebody because they fall asleep at the wheel. So before, it was all with pen and paper, and there were sort of audits and checkpoints throughout the country. But if you had half a brain, you were able to figure out how to get around this stuff. But now with GPS and all this electronic logging device stuff, it's they've kind of closed the loopholes on that. So you can see the trucking rates just in the last few months have just gone skyrocketing. So this is going to get passed on right to the consumer. Working for the railroads are very leading indicator for economies. They're hauling a lot of the raw products like the lumber, the coal, the products that are going to start that a lot of the developers are going to use. So if you kind of watch them, you can kind of get a leading indicator of what's happening in the economy. And everybody says that the unemployment is going, steadily going up. I think a lot of us can agree that it's not really going up. Um, there's just another graphic that kind of shows that and what, cause they keep changing the way they measure this thing. A lot of people that have just given up, they kind of just take out of the study. So it makes the numbers look a lot better than what they are. Here's an article out of Forbes kind of talking about it. And they're saying if we had 20 million workers who presumably would have jobs, but suddenly find themselves without job opportunities because of automation and other forces, this is not an environment in which we are going to see wage inflation. So it takes us to wage rates. So as you can see, the bottom 3-4 lines, that's most of America. And as you can see, it's pretty much flatlined since the last 50 years or so. The only people getting pay raises are the top 5 and 25%. Some other economy trends, the workplace is actually getting less productive. I don't know if they're just playing on their phones in the bathroom or what. Even from a decade ago, they went down from 0.6% compared to 2.4. I'm just saying someone is going to push the button on an automatic McDonald's and things will never be the same here very soon. Information and real estate sectors were leading the productivity growth, whereas financial and insurance and construction sectors lagged behind. Businesses are responding to maximize productivity per square footage. So what this means is they're repurposing a lot of building space. So also think about like the driverless cars. It's kind of like a Star Wars dream at this point. But if you don't need, if everybody has a autonomous car, now you don't need parking, and now you just freed up all that parking space for office space or retail space. And now a lot of the people can go to sleep and you can drive 2 hours away and then wake up for work or go or commute home. And so now all the suburbs may come into play. In terms of retail, we talked about e-commerce that sales top $100 billion. And yet that was only 9% of total retail sales. So there's a lot more growth on that retail front for folks like Amazon. And the United States has abundance of retail square footage in comparison to other countries. So I personally am not very bullish on the strip mall, commercial real estate side. So we'll transition here to real estate. Here's a graph showing the supply and the prices. As you can see, we're kind of in the situation where definitely more into a seller's market. I think we crossed over right after 2000, right before 2012. John Burns Consulting, they released this curve here where they kind of predict where different markets are at in the cycle. I wouldn't read in too much into this. This is just one opinion. And I would also add, like, if you're buying an average deal, you probably are going to get screwed later on, right? Like, yeah, you should be able to buy a deal in any of these markets as long as it's undervalued, under market rents with a story. You should be able to make it work, and that's the key. But problem is that's the minority. I mean, that's like the 10% or 1% of the deals out there at this point. Some notes on this current market cycle is that the last downtime was 2009, and this has been the longest expansion ever, pretty much in the modern era. The last one was in 1991 to 2001, where the expansion was 121 months. and it's also the most moderate expansion because I could remember back in 2011, 2012, we were pretty much in the doldrums for like 3 or 4 years, and I think a lot of people forget that. And this growth really hasn't happened until like 2012, 2013. So the trend is looking back and appears to be pointing toward milder and longer expansions. Here's an article from CoStar. They're saying Class B apartments are more in demand. And this is where I pulled that catchphrase and I say, hey, we're in the 9th inning, but it's an 11th inning ball game. Here's another image of where we are with supply and demand. This one's sort of seeing 2020 as the top of the market. But, this is all, this is from Moody's, but this is all like estimates. This is a graph of where all the investment from outside the United States is coming in. So a lot of it is coming from Canada, Singapore, China. I know there's been a lot of crackdowns on money coming in from China. They're trying to keep their money in there, but sooner or later, people are going to figure out how to get around the blocks and trying to find loopholes. Here are the top 20 forecasted rent growth markets. It's on the left side, actually. Reno, Sacramento, Tacoma, Colorado Springs. And the national growth for rent is right around 2.5%. So if you guys are underwriting deals, I would start with 2 to 3% as a good starting point. But then always dig down into your local market. Here are the bottom rent forecasts. So you've got places like West Houston, Austin, Wichita. I think a lot of those places are different pockets of the big market. Manhattan's actually looking to decrease their rents. So as far as new builds are a way I like to look at, when you're kind of in a very mature seller's market, look at the new builds coming online and how they're saturating into the market. So when you build something, you're really confident that things are going to get better because these things have a long timeline to go through permitting and going through the process. So when people build, they believe the conditions are right to buy the land, buy the materials, buy the labor, do the permitting. So it's hard for a developer, and that's why it's very risky because they have to put all this time and effort and resources into hope that when they're done, when they finally come into bat 3, 4, 5 years later, that the market is still good. Some of the new trends and building, the LVT flooring. I mean, that's a no-brainer. Like that's a pretty good thing to use. I think you're going to start to see light gauge steel come out, which are some ways to cut costs. That might be more on like a larger scale building. LVT flooring is used in a lot of the single family homes we like to buy for rentals. We're not building a lot of new homes, but some of these real estate developments that I'm kind of taking a look at these days, they're kind of looking to cut costs, and light gauge steel is one of those ways. Short-term rentals is also another big trend coming. I'm not a fan of short-term rentals because I always try and get away from things that have a low barrier to entry. And it just seems like everybody can get into short-term rentals because they have some extra room or they have an extra home that they want to rent. And when you're working amongst other people who are unsophisticated, it just becomes a race to the bottom. And, not to mention all the government litigation that's going on with that. So I would say follow the money or follow the lending. Where is the lending going? And Fannie Mae and Freddie Mac, the government-sponsored entities, they're looking to pour money into single-family home pools. So like, big portfolios of like 20 or 80 single-family homes. They're also looking to lend on multifamily short-term rentals or mixed. Um, because before they didn't really have a way of evaluating that before. They'll be like, okay, so you have a 100-unit building and you have 10 of those that are short-term rentals. They're like, well, we can't count that as like the income that you're counting. We're just going to count it as long-term rental income based on your pro forma from the other 90 units. Now they're kind of loosening up their standards, and we may also see assisted living facilities getting some help from Fannie Mae. So that may help a lot of assisted living operators out. Some markets to watch, and just another rendition, another survey out there. I wouldn't put too much emphasis on these kind of charts. And another table on where the new builds are. So they're saying they took a look at where the multifamily permits are coming out. So New York, Dallas, Los Angeles, and then on the right side, Dallas, New York, DC, Seattle. There's a chart on the current supply. So I kind of like these charts. I mean, they're not too valuable, but they're kind of interesting. And on the left side is a change in number of housing units, and on the bottom is a change in median sales prices. So here's a neat one for you multifamily guys. So on the left side is the change in the average cap rates. So obviously, I mean, you're looking for a higher cap rate because that's the higher yield you're going to get. On the bottom is the 10-year analyzed appreciation. So that's how much like your market appreciation you're going to get. So this one's split up in 4 quadrants. Obviously, you don't want to be in that bottom left quadrant. The bottom right is elevated appreciation. The top, you want to be above average cap rates because a lot of our investments that we go for are cash flowing. So that's where that line is. You see the orange dot in the middle is the United States, and that's sort of the average. So you want to be above average. So you want to be above that line. And then on the left side of that line is the yield side, and on the right side is where it's really outperforming. So it's not to say that you just pick a city above that line, but certain cities, the ones circled here, are supposedly the ones with the economic drivers behind them that are probably some of the best tier markets. Dallas, I'm a fan of. San Antonio, Houston, I'm a fan of. Phoenix, Atlanta, Carolinas. Yeah. This graph kind of says that there's going to be a lot of rent growth in some of these markets. So they were kind of saying that there's going to be a lot of shaking out here. This is the apartment unit mixes. So this goes down, and this kind of follows a decade trend. So as you can see, take a look at the orange, right? So the orange is slightly expanding, and the yellow, which is a 2-bedroom, is slightly decreasing. So what I read it is a lot of the 2-bedroom apartments are going down to a 1-bedroom apartment, and a lot of the efficiency units are getting bigger. So the trend is smaller units. And that probably makes sense, right? Because, the haves are getting richer and the poor are getting poorer. And, if you had a 2-bedroom apartment in the last generation, you probably could only afford a 1-bedroom these days. Some of the amenities that a lot of apartments are offering these days. A lot of us, we like the Class B and Class C apartments. So, you're not going to put like that Apple Home or that Google Echo thing or whatever in your units, nor are you going to put USB power ports. But some of these things are good to, put in there, like dog parks. Like I know tennis, nobody plays tennis anymore. They rather have their dog. Like people aren't having kids, they're having dogs. So, transitioning them into, tennis courts into barbecues or dog parks seems to be a very common thing amongst multifamily transitions. Talked about the student debt, and there's a lot of supply coming online for new builds for the student housing. And again, I'm not a fan of student housing. It's another niche thing, just like military housing. It's so predicated on, if the military is spending there, and just one president can totally change, if a military town just goes totally offline. And this kind of goes head to head, which I think is the next bubble, which is the student housing bubble and the student debt bubble. I mean, I just think it doesn't make sense for kids to go to college to get these like crappy degrees. I mean, they're spending so much money, and I think all the signs point to, at some point, it's just going to pop. For you guys trying to fill vacancies in your units, it's still word of mouth is the best way to get the word out for your apartment. And then the next thing is the internet, and not very many people are using the newspaper, the agent, the listing service, but the sign is still about 10% effective. It gets 10% of the people in the door. So some miscellaneous other trends, cryptocurrency. I'm not a fan of that. It's been the story of the year, and I'll just comment, like, remember what real investing is. Is it a hard asset? Does it produce income, and is it use prudent leverage? Wealth comes to those who create value. Improving living conditions for tenants is creating value. Not riding trends or selling on Amazon in an arbitrage role. That's not creating value. You might make money, but you're not creating value. And true wealth comes to people that create value. And also, cryptocurrency, anybody can get into. If you got $5, $50, you can get into cryptocurrency, which, like I said earlier, I stay out of things that have a low barrier to entry. And it's just like the Conor McGregor fight when he fought Floyd Mayweather. Look to where all the unsophisticated money was going. It was going to Conor McGregor. I mean, if you looked at the odds, I mean, here you have this non-professional boxer. It's a gimmick fight, yet the odds were in such a way that Conor McGregor had just as good as a chance of beating Floyd Mayweather as Manny Pacquiao, a very formidable opponent. So that was a situation where the groupthink thought that Conor McGregor was a lot better than what he was, or maybe people just threw play money into it. I mean, but the smart money betted on Floyd, and he made big. Another trend here is, there's just a lot more natural catastrophes happening. Floods, heat, fire, storms. And other fun trends, the millennials, they like to share everything. They think renting is more appealing. I guess the girl over there is selling plasma or eggs or whatever. Suburban, people want walkability. So you're looking at like these mixed use mini city centers coming up, very popular. And then here's a list of different like areas that are kind of like that. There's, I don't know where you are in the world, but if you kind of see one of these come up, that's a good place to invest. The potential bubbles that I'm seeing: delinquency in auto loans made to subprime borrowers. A lot of them are made to 705 score people. Student loans rose from $13 billion to $1.3 trillion. Like I said, I talked about that one earlier. Credit card debt up. More good mortgages are coming on. 760 median score. Obviously increasing debt for normal folks. increasing consumer confidence by manipulating statistics like the unemployment and headlines about outsourced labor and technology taking human jobs. So here is an interesting graphic here about, you see the corporate, everyone says like the corporate tax rate that Trump did is going to affect a lot of things, but as you can see, like it doesn't really change things that much. You see that bold purple line? So that dropped in 88 and it just really didn't do too much. I mean, maybe it did, but it was a big leg for it to really take into effect. So I guess the takeaway here is don't count on corporate taxes to stabilize or stimulate the economy. So in conclusion, we talked a lot about different data here, and I just don't read into it too much. Put this slide in here just to kind of lighten the mood a little bit. So everybody knows that we had this missile crisis, and everybody freaked out and thought they were gonna die because North Korea was gonna bomb us. But so I guess fun little graphic from Pornhub, the pornography website. They I guess the alert came out, and then the traffic on Pornhub just like went down by like 80%. And then it took, if I measure it, if the alert went out like at 8, about an hour later, that was how long the panic took. So everybody was like, okay, we're going to live. Let me get back online. So I guess, like this, does this data, like, don't read into it too much. Be aware of it. But, sometimes when you see this data, you start to look for things that aren't there. It starts to justify stories in your head. A lot of you guys may see, there was a big message about the seller's market in this presentation, and you might just be thinking, I'm just going to sit back and wait for prices to come down. And I'll use this analogy of a coin, so you can if you have that thinking, you're thinking that I'm going to wait or I'm going to buy because based on the market. But Robert Kiyosaki says that there are 3 sides to every coin: a head, tails, and the edge. Your ability to understand contrasting points of view and ability to glean what information you believe to be valuable from each side is a crucial skill. So me personally, I always try and stay on the edge of that coin. Like I said, I don't buy, based on like a trend. I buy independent of that. So even if like all the data is saying that you're in a seller's market and you shouldn't buy, like I'm going to still buy if there's under market rents, if it's undervalued and there's ability to do some rehab and increase those rents even further. That is standing on the edge of the coin and not just using the seller's market as an excuse. And I'll even take it a step further. If you're going to use that as an excuse not to do anything, I mean, really, what else are you going to do? I mean, you're screwed if you don't do anything. I mean, just look at all the inflation numbers out there. So some more conclusions here. This is a diagram of the cap rates. The tertiary markets is in blue. The secondary markets where we like to invest is in the gray, and the primary markets, the high price places that don't make sense from a cash flow perspective, is in the black. So this is a picture of how they track all in one. There's always a gap, right? So lately what has been happening since probably about like a year or 2 ago is that, we always like to stay in secondary markets in that B tier, but there's been a trend to go to the A market or probably a B plus market and get those properties because the pricing is just very similar. But the takeaway here is that, this all tracks together. And then you've got this other thing going on where, brokers will say, hey, buy now so that you can lock in low interest rates. But my argument is, who cares about the interest rates? Because interest rates and cap rates, they are sort of correlated. And in this diagram, you have in the blue on the bottom, those are the interest rates, and on the top is your cap rate. And sometimes you have this thing called cap rate compression, here illustrated in the red here, where sometimes the normal delta between them gets a little compressed. That's the term cap rate compression. Those are the times when you don't want to buy. And that probably happened early 2017. There was a little bit period of that, but things was kind of spaced out from there. You as an investor make money on the delta between the cap rate and the interest rate. And that is independent of the market. So look, here you have it again. You got the interest rates on the bottom and the cap rates on the top. You know, this is irregardless of a good market. I mean, look at a good market was in 2016, or a seller's market was 2016, right before the recession. That was not a good time to buy, when that was definitely a cap rate compression period. Right now, I mean, they're saying we're in the 9th inning of 11th inning ball game, but I'm like, who cares? The spread between the cap rate and the interest rates are very healthy. And again, this is the third side of the coin that I'm talking about. You want to buy, you're not buying the deal that the broker is giving you. You're buying that 1 out of 1,000 deals that you see, which is there's a story component. There's an undervalued purchase price. There's an under market rents. And when you have those two components, you're getting out of that water level. You're going to do some rehab to force additional value. And heck, you might even get lucky with an emerging market or market appreciation. But even if you don't have that, you're still above water. So I think I want to talk about this Black Swan event. So we're all humming along. The economy's sort of going well. The cap rate and interest rates has a spread, but it's all going well, and you can flip homes, and you can kind of take chances. But if a Black Swan event happens, you're screwed. And what this is, it's a metaphor that describes an event that comes after a surprise and has a major effect. It's inappropriately rationalized after the fact with the benefit of hindsight. So the story is that, like, in the ancient saying, which presumed black swans did not exist, but then after all, they did exist in the wild. So the diagram on the right is, see that where that is it's like a graph, a probability of an event happening on the y-axis. On the x-axis is like minimum impact or catastrophic impact. So that little swan is sitting on that very low chance of happening or very big impact. So a lot of you guys are, in Seattle, and I was sitting on a risk analysis team, and we're looking at that Big Bertha tunnel. And for those of you who don't know, there's this big high profile project going on in Seattle, that there's this big drill that's tunneling through underneath downtown Seattle. And there's this big important part that just happened to break. And when, like, years before the actual construction, this event happened, this black swan event happened. And it was a very low chance of happening, but it was a very high impact catastrophic event. But it just didn't warrant having an extra one of those parts on standby. So, I mean, it's a big political blow up, but it's like, from an engineering perspective, it's like, what are you going to do, So here are some examples of a black swan event that we could happen, the sharp repricing of the Fed expectation, something going wrong with China or Russia with all the oil stuff, some, double drag from European policy, investment in Japan. There's some other things that could happen. Oh yeah, like a ballistic missile threat could do that. But I'll just end this with, you've got two choices, just like there's two sides of the coin, but you can choose, if you don't do anything, what you're going to get if you keep investing in the stuff you're doing currently now. You already know. And just time is going to go pass you by. And my mentor says that your life as an entrepreneur is determined by an easy trace back to individual yes or no decisions. So zeros and ones if you're a computer programmer. Regret is the strongest emotion. I mean, it's a seller's market, but I am telling you that investors go off of the delta between the interest rates and cap rates, and that's usually pretty consistent. So just make sure you're playing to win, just not to lose. And Robert Frost says, two roads diverged in a wood, and I took the one less traveled by, and that made all the difference. So in closure, simple passive cash flow is about redirecting billions of dollars to Wall Street casinos and corrupt financial institutions to help the middle class, you guys, find safer, more profitable investments in Main Street opportunities benefiting local communities. And my job here is to create a hui, or a community family of successful investors who learn from each other. So you guys action plan and check out Simple Passive Cash Flow and kind of learn about investing. Join the Hui Do Pipeline Club, which is a free investor club where I filter investments and I underwrite the numbers and partners myself. And unlike other investment lists and groups, my investors have personal access to me and know that I personally have skin in the game alongside my investors. If you guys have any questions, email me at lane@simplepassivecashflow.com for access to deal flow. And I guess we'll probably see you guys next time. Bye.